Welcome to the Nifty Noon podcast.
It's great to be here.
So we usually start these deep dives with a bit of a warm-up. We might talk about a new NFT project or a weird trend in the metaverse, maybe crack a joke about the price of gas.
Yeah.
But today feels different. We kind of have to read the room.
We do. And the room is currently on fire.
It is early February 2026, and if you've looked at your portfolio in the last, say, 5 days, you might be feeling a little bit queasy, maybe even a distinct sense of vertigo.
Vertigo is putting it mildly. The crypto markets have just undergone what can only be described as a violent hard reset. We're talking about a week that will likely be circled in red ink by historians of this asset class for a long, long time.
Exactly. We're talking about a week that started with some post-holiday jitters and ended with Bitcoin erasing every single dollar of gain it made since the November 2024 election.
The entire Trump trade.
Gone. The narrative that drove the market for over a year, just gone.
Completely wiped out. And what we want to do today is really parse through the wreckage. Because when you look at the daily updates from our newsletter this week, a very clear, albeit painful, story emerges.
Right.
It isn't just a story about prices going down. It's a story about a brutal leverage flush, sure. But it's also about a clash between two very different types of market participants operating on two completely different timelines.
You're talking about the massive liquidation cascades. Over $1 billion evaporated in hours.
In hours.
But at the same time, right in the middle of the fire, you had corporate treasuries like BitMine acting like absolute gladiators buying the dip, while the massive ETFs were bleeding record outflows.
It was a battle of diamond hands versus forced sellers. And as if that wasn't enough drama, right in the middle of all this chaos, we had a major technical pivot from Ethereum's founder, Vitalik.
Oh, yeah.
He basically decided this was the perfect week to, rip up the Ethereum roadmap and start fresh.
Which is just wild timing. Usually you drop big technical news when the market is green and everyone is happy.
Right.
Doing it while the ship is listing to the side is a bold strategy.
It sends a message.
So our mission for this deep dive is to go day by day. We're going to use the daily updates from our newsletter to track how a buy-the-dip opportunity on Monday turned into a catch-a-falling-knife scenario by Friday.
Let's get into the wreckage.
Okay, let's rewind to Monday, February 2nd. The newsletter called this the hard reset. Now, looking back, the signs were there. The week opened with a holiday in parts of the world, liquidity was thin, and then snap.
That sound. That is the sound of a mechanical failure in the market structure. You have to remember, markets rely on order books. It's a list of people willing to buy and people willing to sell.
Sure.
On a Monday holiday, the buy side of that book, the people standing there with catcher's mitts, was incredibly thin.
So when the selling started, there was just no one there to catch the ball?
Precisely. And when there are no buyers at 78,000, the price just teleports to 77. And if there are no buyers there, it goes lower. Monday was a liquidity vacuum.
And Bitcoin fell below 77,000. Ether lost that critical $2,300 support level.
And the newsletter highlighted that in just 4 hours, $1 billion was liquidated.
Okay, I want to pause on that because we throw around the word liquidation a lot in this industry. For the listener who might be holding spot, just buying Bitcoin and holding it, what exactly is happening to these people?
It's a forced ejection. These are traders using leverage. They borrow money from the exchange to bet the price will go up. Let's say they put down $10 to bet 100.
Right.
If the price drops just 10%, their $10 collateral is gone. The exchange's computer, not a human, a computer automatically sells their position to get its loan back.
And when the computer sells, that drives the price down further.
Which triggers the next guy's automatic sell order, and the next. It's a domino effect. That's why you see these vertical red lines on the chart. It's a cascade of robots selling into a market that has no buyers.
And caught in those dominoes were some massive corporate players. This is where we need to talk about paper losses, because the numbers here are just eye-watering.
They are historic. The concept of unrealized losses is the psychological killer of the market. If you bought an asset for 100 and it's now worth 80, you haven't lost $20 until you click sell.
Right.
But you have to look at it on your balance sheet every single day. And for BitMine Immersion Technologies, that hurt was to the tune of a staggering $6 billion.
$6 billion in unrealized losses. That is larger than the GDP of some small nations. It's just hard to wrap my head around a board of directors sitting in a room looking at a $6 billion hole and staying calm.
It requires an iron stomach.
Mm.
And they weren't alone. MicroStrategy was taking a hit too. For a brief moment on Monday, MicroStrategy dipped underwater.
So the price of Bitcoin fell below their average cost basis of what, around 76,000?
Exactly.
Wow.
And that feels like a huge psychological barrier. For so long, the narrative was MicroStrategy is always in profit.
For Michael Saylor and his team, I mean, they've been here before. They have deep cash reserve. They aren't forced to sell.
But psychologically, for the rest of the market, seeing the heavyweights in the red is a massive signal. It creates fear. It tells a retail investor, if the whales were drowning, what chance do I have?
And it wasn't just a crypto vacuum, was it? The newsletter mentions some external factors adding fuel to the fire. You can't ignore the macro.
No, crypto doesn't live in a bubble. We had a U.S. government shutdown scare looming, which always makes markets jittery. Geopolitical tensions were ramping up, and we even had a bank failure.
Oh, right, the Chicago Bank, Metropolitan Capital Bank and Trust.
Exactly. Closed by regulators due to unsafe conditions. And now, Metropolitan isn't Chase or Bank of America. It's a smaller player.
Sure.
But in finance, you have what's called contagion fear. When one bank fails, investors don't wait to check the balance sheet of the next bank. They just run. They want cash. And to get cash, they sell the most liquid, volatile assets first.
Which is usually crypto.
It's always crypto. Crypto is the only market that is open 24/7. If you need liquidity on a Sunday night or a holiday Monday, you can't sell your house, you can't sell your stocks, but you can dump your Bitcoin.
So Monday sets the stage. We're bruised, we're battered, the tourists have fled. And usually this is where you'd think, okay, the leverage is flushed, we can rebuild.
Yeah.
But then comes Tuesday, February 3rd. And this is where the story gets really weird.
Tuesday was the false hope, or maybe the gladiator moment, depending on your perspective. Because despite everything we just discussed, the crash, the fear, the $6 billion hole, BitMine did something that shocked everyone.
They bought more.
They didn't just buy a little, they went big.
According to our newsletter, BitMine Immersion Technologies acquired another 41,788 ETH.
Yeah.
That brings their total stash to over 4.2 million tokens.
Let's just put that number in perspective for a second. 4.2 million ETH is roughly 3.5% of the entire circulating supply of Ethereum. One single firm holding nearly 4% of a global decentralized network.
That is just so aggressive. I mean, here we are, the market is melting down. They were sitting on billions in paper losses, and they decide to double down. Is that smart? Or is it reckless?
It's extreme conviction. But you have to look at why they are doing it. If they were day trading, hoping to flip that ETH for a quick profit next week, this would be insanity.
Right.
But they aren't trading the coin. They're betting on the infrastructure. The newsletter mentioned their Mavan validator network launching later in 2026.
Right. The Made in America validator network. Can you explain the difference between just holding the coin and what they're doing with this network?
Sure. Think of holding the coin like buying a plot of land and hoping the property value goes up. What BitMine is doing is building a toll booth on that land.
Okay.
By staking that 4.2 million ETH in their Mavan validators, they are helping to process transactions and secure the network. And in return, the network pays them.
They get a yield.
A massive yield. They think that once that network is live, the staking rewards could be over $1 million a day. So in their view, the price of the token today matters less than the revenue stream they are building for tomorrow.
So they're just playing a completely different game.
Completely different. They are looking at a 10-year horizon. The panicked market is looking at a 10-minute horizon.
It's a cash flow play versus an asset appreciation play.
Exactly. But while BitMine was playing 4D chess, the regulatory environment was playing a very messy game of checkers. Tuesday also saw a meeting at the White House between banking groups and crypto reps.
And let me guess, it didn't go smoothly.
Not exactly a love fest. The reports from the newsletter indicate a real clash of cultures. The crypto reps went in wanting to talk solutions, specifically about yield, custody, how to integrate this stuff safely.
And the banks?
The bank reps mostly avoided details. They just stonewalled. It highlights this ongoing tension. You have the new guard of finance desperate for clarity, and the old guard dragging their feet, maybe hoping the problem just goes away.
Speaking of things that won't go away, there was a weird little history note in Tuesday's newsletter that I have to mention. It's almost too strange to believe.
Oh, you mean the Amir Taki emails?
Yes, Amir Taki, an old-school Bitcoin developer, releasing emails from 2011 between himself and Jeffrey Epstein.
It's one of those strange cultural intersections that only happens in crypto. Apparently, Epstein reached out way back in 2011 because he thought Taki was the CEO of Bitcoin.
Which is hilarious because, famously, Bitcoin doesn't have a CEO. That's the whole point.
Precisely. But it shows how long wealthy, connected people have been sniffing around this space, trying to find the manager to cut a deal with. It's just texture.
It definitely keeps things interesting. Okay, moving on to Wednesday, February 4th. The price action was choppy, but the real story was technical. This is where Vitalik Buterin enters the chat and drops a bombshell.
This was a technical pivot of massive proportions.
Yeah.
For the listener who isn't a developer, here's the context. For years, the Ethereum roadmap has been rollup-centric. The idea was that the main blockchain layer 1 would just be a slow, expensive settlement layer, and all the user activity would happen on cheap layer 2s like Base or Arbitrum.
Right, that's been the gospel. Scale on L2. Keep the main chain for the big boys. But on Wednesday, Vitalik said, maybe not.
He declared the old roadmap obsolete. He pointed out a fatal flaw. L2s are centralizing too much. They are stuck at what he calls stage 0.
Stage 0 sounds like beta testing. What does that mean practically?
It means they still have training wheels. It means the company running the L2 still holds the admin keys. They can freeze funds. They can upgrade the code without your permission.
So it's not really decentralized?
Not at all.
Yeah.
Vitalik is looking at this and saying, this isn't crypto. This is just a database with extra steps. It defeats the whole purpose. If a company can freeze my money, I might as well use a bank.
Exactly.
So he is pivoting. He wants to re-empower the base layer. With the upcoming Glamsterdam fork, they're looking at huge increases in capacity on layer 1. He wants Ethereum to return to the world computer model.
Where the base chain is powerful enough to handle the load itself.
And ensure true decentralization.
Yeah.
It's a move back toward purity and security over just raw speed.
It's fascinating that he chose this week, amidst all the price chaos, to have this big philosophical debate.
It shows that the builders were still building. And the newsletter backed that up with adoption news on Wednesday, too. Y Combinator, the biggest startup accelerator in the world, announced startups can now take their $500,000 funding in stablecoins.
That is huge. That isn't speculation. That is operational efficiency.
It is. And you had Tether and Opera expanding mini-pay for emerging markets. The rails of finance are being laid down even while the casino upstairs is catching fire.
The utility is growing even if the asset price is shrinking.
That's a great way to put it.
Because on Thursday, February 5th, the casino got another surprise. Vitalik was back in the headlines, but this time he was selling.
The philanthropic liquidation. Usually, when a founder sells a large chunk of tokens, it's a panic signal. Investors think, he knows something we don't. He's cashing out before the collapse.
And Vitalik sold about 705 ETH, worth around $1.6 million. And the newsletter noted he has moved about 6% of his holdings recently.
Right.
But the market didn't crash on this news.
It actually pumped briefly, about 5%.
Why? I mean, usually founder selling is the kiss of death.
Because of where the money is going. He isn't buying a mega yacht. He's not buying a private island. He's funding Canro, his biotech charity, and supporting open source hardware. He calls it Ethereum for people who need it.
So the market interpreted it as benevolent. He's funding the ecosystem and global health, not abandoning ship.
Exactly. It reinforces the ethos of Ethereum. And frankly, 1.6 million is a drop in the bucket compared to the volumes we're talking about.
Yeah.
But the signal was positive. It wasn't a panic sell.
We also saw Ripple making moves on Thursday, announcing support for Hyperliquid.
This is significant infrastructure. Hyperliquid is a decentralized exchange for derivatives. Ripple getting involved means institutional access to on-chain trading is getting better. Again, same theme. The tech is advancing. The pipes are getting upgraded, regardless of the price action.
But then came Friday, February 6th.
The floor fell out.
If Monday was a tremor, Friday was the earthquake.
Right.
Bitcoin just plummeted to $60,050.
And that number is significant because it marked the official death of the Trump trade. All the gains made since the election on November 5th, 2024, gone, erased. We are back to square one.
The newsletter called it capitulation, and this wasn't just leveraged traders getting liquidated this time, was it? We can't blame the Degens for this one.
No. This was something scarier. This was spot ETF outflows.
The data in the newsletter was just stark. $545 million in net outflows in a single day.
And BlackRock's IBIT, the giant, the one that was supposed to suck up all the Bitcoin supply and send us to the moon, lost $373 million in one day.
That is a massive reversal. For months, the narrative has just been the ETFs are buying, number go up. Now the ETFs are selling. Why is an ETF selling so much worse than just a regular person selling?
It's the mechanism. When an ETF sees net outflows, meaning more investors want to sell shares than buy them, the ETF issuer must sell the underlying Bitcoin to rebalance the fund. They are forced sellers.
So they don't have choice.
They don't look at the chart and say, maybe we should wait for a bounce. No. They have to sell to match the redemptions. It creates a negative feedback loop.
Right. Spot selling drives the price down. Retail gets scared. They sell more ETF shares.
And that forces BlackRock to sell more Bitcoin. It just spirals.
The sentiment in the newsletter shifted from buy the dip to forced selling in defense. They even started comparing the losses to Archegos.
And that's a chilling comparison for anyone in finance. Archegos was a family office that blew up in 2021 and caused billions in losses for major banks. The newsletter noted that BitMine's unrealized losses are approaching historic levels, potentially the 5th largest trade loss in history if they were to sell.
But they haven't sold yet.
Not yet. But the market is now asking, can they hold on? When you are down $6 billion, your lenders start making phone calls, your board members start scheduling emergency meetings.
So the fear is systemic risk.
Exactly. The fear gripping the market on Friday wasn't just about the price. It was about what happens if a whale the size of BitMine is forced to liquidate. $60,000 won't hold.
So let's try to unpack this entire week. We've gone through the daily grind. We started with a leverage flush, saw corporate bravado from BitMine, a technical rethink from Vitalik.
And then ended with total ETF capitulation on Friday. It's a classic narrative arc of a crash. Denial, bargaining, and finally, acceptance.
If we look at the signal versus the noise here, what really matters? Because there was a lot of noise.
The noise is the day-to-day fluctuation of NFT floor prices. The newsletter tracked pudgy penguins and apes going up and down, but really they were just bobbing on the waves of the macro tsunami. The Epstein gossip. Interesting, but noise.
And the signal?
The signal is the ETF flows. That is the critical metric. As long as those flows are negative, it is very, very hard for the price to find a floor. That is the new gravity of the market. The bleeding has to stop there first.
And I'd argue Vitalik's roadmap change is a huge signal, even if it didn't save the price this week.
Oh, absolutely. That will define Ethereum for the next 2 or 3 years. Whether ETH is 2,000 or 4,000, the architecture is shifting back to the base layer. That changes where developers build and where value accrues. That's a long-term signal.
And then there's the resilience or stubbornness of the corporate treasuries. BitMine, holding through billions in paper losses, is a high-stakes game of chicken.
It is. They are betting that this hard reset is temporary. They are looking at the on-chain data transactions are high, adoption is happening, and they believe the price will catch up to the utility. They think the panic is emotional, but the tech is real.
But the market right now is telling them they are very wrong.
The market is a voting machine in the short term, and right now it's voting no. But as the saying goes, in the long term, it's a weighing machine. BitMine is hoping they have the weight to survive until the voting changes.
So what do we watch next?
We watch the flows. Can the market stabilize without the ETFs buying? And we watch the liquidity. If BitMine or MicroStrategy blink, if they're forced to sell, we are going to see a much deeper flush.
That brings us to our final thought. The newsletter posed a provocative question to end the week. A question that I think every listener really needs to sit with.
It's the essential question.
If the Trump bump is gone and the ETFs are selling, who is left to step in? Who is the buyer of last resort?
It's the million-dollar question. Or in this case, the trillion-dollar question. We've relied on institutional buying for the last year. If that reverses, we are back to organic demand. We are back to the believers. And we have to see if that demand is strong enough to hold the line at 60,000.
It's going to be a nail-biting few weeks.
Indeed. But remember, volatility is the price of admission in this asset class. We've seen these flushes before. They clear out the leverage, they punish the reckless, and usually they set the stage for the next leg up. But you have to survive the flush first.
You have to survive the flush. Words to live by. Thank you all for joining us on this deep dive into a chaotic week. We hope this helped you make sense of the red numbers on your screen.
Stay safe out there.
And if you want to keep up with this madness day by day, you know where to go. Follow Nifty Noon on X and Substack. Their daily updates are the reason we can bring you this analysis. Thanks for listening, and we'll catch you on the next deep dive.